Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Today is Thursday, November 27, 2025. It's Thanksgiving here in the U.S., so markets are closed, but the global financial world, well, it is definitely not taking a break.
Not at all.
We have a really crucial deep dive for you today, pulling from a whole stack of sources: CNBC, Morgan Stanley, Bloomberg, even MIT. We're tracking three big interconnected themes. First, the relentless AI hardware and workforce arms race.
Then there are these key shifts in global tech dominance.
And finally, some critical economic pressure points brewing across China and Russia. Our mission today is to cut through that noise and show you exactly why these stories matter right now.
That's right. And even with the U.S. markets quiet today, they ended Wednesday on a high note. Major U.S. indexes logged a fourth straight day of gains, and according to CNBC, that was lifted primarily by tech names. Oracle was a big one.
And the driver behind all this optimism seems to be the Fed.
It's all about the hope for a Federal Reserve rate cut in December. I mean, if you look at the CME FedWatch tool, markets are pricing in roughly an 80 to 85% chance of a quarter-point cut next month.
Wow. That's a pretty strong consensus.
It really is, and that optimism is spilling over globally. We saw Asia-Pacific markets mostly in the green. India's Nifty 50 hit a record high. Japan's Nikkei was up 1.23%. European markets also edged higher, with the Stoxx 600 up a bit.
And to anchor this bullish mood, the CNBC Daily Open pointed out some just incredibly aggressive S&P forecasts.
Oh, yeah. One JP Morgan strategist suggested the S&P 500 could hit 8,000 by the end of 2026.
8,000.
Now, that's if certain specific conditions are met, of course, but that level of long-term confidence is definitely something to keep in the back of your mind as we get into some of the underlying risks.
Okay, let's do it. Let's jump into that AI arms race, starting on the consumer side with hardware. Our sources here, CNBC and Bloomberg, are all over Alibaba's big move into consumer tech with their new Quark AI glasses.
This is a pretty big deal. You know, Alibaba has historically been all about cloud and e-commerce, not really cutting-edge consumer gadgets.
Right.
But they've launched two versions of these glasses, both powered by their own Qwen AI models. There's a premium S1. That one starts around $536 and has built-in translucent displays. Then there's the cheaper G1, which skips the screens. Both run on Qualcomm's Snapdragon AR1 platform.
So what's the end game here? This has to be about more than just another wearable.
Oh, it's absolutely a platform play. Alibaba is taking a page right out of Meta's book. They're betting that smart glasses, the kind that integrate AI and augmented reality, are the next essential device after the smartphone.
And the features reflect that ambition.
Totally. You've got on-the-go translation, AI-generated meeting notes, and this is the critical part, a direct link to their e-commerce engine, Taobao. You can literally point the camera at a product, and the glasses pull up pricing info.
That puts them in direct competition with Meta's Ray-Ban glasses, but the timing for Alibaba is, well, it's complicated, isn't it?
It's very complicated, and you can't really talk about this launch without mentioning the geopolitical overhang. Bloomberg detailed an October 7th memo from the Pentagon that cited Alibaba, along with Baidu and BYD, for potential inclusion on the 1260H list.
And for anyone who doesn't follow this, being on that list means you're identified as a company potentially helping the Chinese military.
Yeah.
That has to be damaging.
The implications are profound. I mean, if they're formally added, it could severely restrict their access to U.S. capital, to American tech, to partners. It's a huge deal. Now, Alibaba has flatly denied the claims, saying there's no basis for it.
So if you connect those dots, this aggressive push into a new consumer platform right now, it almost feels like a strategic hedge.
Exactly. It's like they're trying to build a fortress in their home market at the very moment their global ambitions might be under threat. It makes this product launch much, much higher stakes.
Okay, so moving from consumer tech to the corporate world. The enterprise AI war is all about massive, massive infrastructure spending, and this is creating real credit risk. We're pulling from Morgan Stanley and Yahoo Finance here.
Right. This is where the sheer cost of the AI build-out starts to make Wall Street nervous.
Okay.
Morgan Stanley put out a warning about Oracle, specifically its debt risk. A key gauge, what's called a credit default swap, or CDS, hit a 3-year high. They warned it's at risk of topping the 2008 record.
You just quickly unpack that for our listeners. What's a credit default swap, and why is a surge like this a red flag?
Sure. Think of a CDS as just an insurance policy against a company defaulting on its debt. So the higher the price of that insurance, the more the market thinks there's a real risk of default.
Okay.
And the key here is why it's rising for Oracle. Bloomberg noted that banks are hedging their risk on a massive, reported $38 billion loan package. And that loan is financing huge data centers like those run by Vantage Data Centers, where Oracle is lined up to be a major long-term tenant.
So the risk isn't just Oracle's own borrowing. It's bigger than that.
Precisely. The risk gauge isn't just about Oracle's balance sheet. It's reflecting the anxiety banks feel about these enormous data center construction loans in general. Oracle, as the anchor tenant, kind of gets its own risk profile dragged higher right along with it.
Now, in contrast, the story around NVIDIA is less about credit and more about, well, the very nature of its growth. Short sellers are drawing some pretty serious historical parallels.
That's the story Yahoo Finance was covering, citing people like Jim Chanos and Michael Burry. They're alleging that NVIDIA is using what they call circular financing. The comparison they're making is to Enron or Lucent during the dot-com bust.
A dramatic claim.
It is. The accusation is that NVIDIA invests in these high-profile, often money-losing customers, think OpenAI, xAI, CoreWeave, who then turn around and use that same money to buy NVIDIA's chips. It creates this kind of closed-loop demand bubble, or so the theory goes.
But does that comparison actually hold up? What's NVIDIA's response?
NVIDIA pushes back hard. They argue their business is economically sound, not at all like Lucent, which was known for vendor financing that stretched payments out for years. NVIDIA's point is that its customers pay up within 53 days.
And that speed of payment is the key difference.
It's a big part of their rebuttal. If cash is changing hands that quickly, and these customers are also raising huge amounts of money from other investors, it makes it harder to argue that NVIDIA is just propping them up.
So even with these questions swirling, the bull case for AI remains incredibly strong.
Oh, absolutely. You've got analysts like Dan Ives at Wedbush who insist there is absolutely no AI bubble. His argument is simple. Demand for chips still completely outstrips supply. And, you're only in the first inning here. He estimates less than 5% of U.S. companies have even deployed AI meaningfully yet.
So from that perspective, it's not a bubble, it's just building the foundation.
Yeah.
A critical contrast. And this is all happening against a backdrop of some really deep global economic instability. Let's turn to those global stress points, and we have to start with the really concerning news out of China this morning. The contagion risk here is massive. We've got reports from both Bloomberg and CNBC on this.
The property crisis there is definitely getting worse. The big headline is the shocker from China Vanke. Now, Vanke was always seen as one of the healthier, more stable property firms. Not like Evergrande.
The one that was supposed to be safe.
Exactly. And yet they've just proposed delaying repayment on a 2 billion yuan, that's about $283 million bond that's due on December 15th.
Oof. If one of the good ones is asking for a delay, the market must be in a panic.
It is. Vanke's dollar bonds plunged to record lows. Their 2027 bond fell 17 cents to trade around just 23 cents on the dollar. The fear now is massive contagion, because if Vanke defaults, it sends a signal that the government's willingness to prop up even the bad players is fading.
But wait, why wouldn't the government just step in? I mean, if Vanke is that important, wouldn't they want to prevent this?
That is the trillion-dollar question. It might be that the political will is shifting, maybe towards more selective bailouts. But there's also just the raw economics of it. Vanke's contracted sales are down by half compared to a year ago. Even with government support, if you're not selling apartments, it's pretty hard to pay back your debt.
And this property stress is obviously bleeding into the broader Chinese economy.
Without a doubt. The CNBC data confirms it. China's industrial profits dropped 5.5% year-on-year in October. That's the biggest decline since June, and a complete reversal of the growth we saw earlier. It's a clear sign weak demand is hitting corporate balance sheets hard.
Now let's pivot from China to Russia. A Bloomberg analysis shows the economic toll of the Ukraine war is now really starting to bite for ordinary citizens.
Yeah, the Russian economy is really starting to fracture. The wartime stimulus propped things up for a while, but now consumers are feeling real pain. Prices are rising much, much faster than wages, and people are cutting back on absolute necessities, like food. Exactly. Sales of staples like milk, pork, and rice dropped between 8% and 10% in just September and October. That strain is hitting the family dinner table. And it's not just consumers. The bigger economic engine is struggling too. Mining output is down 32%. Coal mining is in its worst spot in a decade, and the lifeblood oil and gas revenue dropped by over a fifth year-on-year.
So what's the long-term outlook?
Well, analysts don't see an immediate systemic collapse in 2026. but they see a steady, grinding deterioration. The budget deficit's projected to hit 2.6% of GDP by the end of this year. They're funding that with expensive domestic debt, which just squeezes out private investment and weakens the whole economy long term.
Okay, let's shift back to technology and a major structural change in global market dominance. This next headline really is a historic shift.
It is historic, yeah. According to Counterpoint Research, which CNBC cited, for the first time in 14 years, Apple is on track to ship more smartphones globally than Samsung. The torch is being passed.
What are the actual numbers here? How close is it?
It's close, but it's a clear lead. The forecast has Apple shipping 243 million iPhones in 2025, just ahead of Samsung's 235 million. That gives Apple about 19.4% of the market to Samsung's 18.7%.
And what's driving this? It can't just be the latest iPhone 17.
The iPhone 17 had bumper sales, for sure, up 12% in the US, 18% in China. But the real driver here is structural. Counterpoint says the replacement cycle is at an inflection point. Basically, all the people who bought new phones during the COVID boom are now ready to upgrade.
And Apple's installed base is just enormous and incredibly loyal.
That's the key. Counterpoint noted that 358 million secondhand iPhones were sold between 2023 and mid-2025. That is a massive pool of existing users who are very likely to just buy another iPhone, and that's what's finally pushing them over the top.
Let's bring it back to AI, but this time, the focus is on jobs and the workforce. A new study from MIT, also covered by CNBC, just dropped what they're calling the Iceberg Index.
This MIT study is so important because it's not just speculation. They used actual labor simulation tools to quantify the risk. And what they found is that AI can already replace 11.7% of the entire U.S. labor market.
11%. What does that translate to in wages?
It equates to about $1.2 trillion in wages across white-collar sectors: finance, healthcare, professional services.
So why the Iceberg Index? What's the hidden part?
Because the visible part, the headline-grabbing tech and IT layoffs you see in coastal hubs, that's only about 2.2% of the total wage exposure. The huge multi-trillion-dollar disruption is what's beneath the surface.
Which is what, exactly?
It's the routine, high-volume functions. We're talking about massive exposure in HR, in logistics, in office administration, basic finance tasks. And the study shows this isn't just a Silicon Valley or New York problem. The risk is spread across all 50 states.
Let's wrap up this infrastructure discussion by looking at Europe. CNBC is suggesting that, kind of paradoxically, Europe's own challenges might actually become a competitive advantage in the AI data center race.
It's a fascinating idea. So right now, the U.S. is clearly winning the AI training, race building these giant data centers needed to teach the models. But in Europe, things like grid congestion and tough regulations force developers to move much more slowly.
And how is moving slowly an advantage?
Because it forces them to be more deliberate. Construction is so hard and takes so long that they have to focus on building state-of-the-art, hyper-efficient facilities that are future-proofed. One fund manager told CNBC this actually creates a safer investment case than the sometimes speculative rush happening in the U.S.
So if the U.S. is winning on training, where's Europe's sweet spot?
Europe is perfectly positioned for AI inference. So if training is like sending a student to college to learn, inference is the quick daily use of that knowledge, answering a query in milliseconds. McKinsey estimates inference will be 70% of all AI demand. And because European countries want sovereign AI, their data processed on their own soil, Europe's established cloud infrastructure gives them a major foothold in what will be the bigger part of the market.
What a sweep. I mean, from Alibaba's AI glasses as a geopolitical hedge to the credit anxiety around Oracle to Apple finally taking the smartphone crown. And all of it is happening against this backdrop of really deep economic stress in China and Russia and this multi-trillion-dollar disruption just looming under the surface of the U.S. workforce.
It's incredibly complex, and you see how all these stress points are connected. We started today talking about market optimism driven by Fed rate cuts. But that optimism depends on stable global conditions. And as we noted, Vanke's sales were cut in half. So here's a thought for you. How much of that optimism relies on China finding a bottom quickly? And what happens to those aggressive S&P 500 forecasts if Vanke signals not a bottom, but a long, unavoidable global slump?
A perfect question to mull over the holiday. We'll see you all tomorrow morning with new headlines from major financial magazines.